what is volatility and what is risk? Let's talk about volatility first and why it's important that you understand what it is and how it relates to your investments. I'm going to keep this short and simple, by the way. Volatility is when an investment or anything that you buy to hold for long term goes up and down in price a lot over a short amount of time. So something is volatile if the price of it goes up by, let's say, 10, 25, 50% or more in a short amount of time. We're thinking in terms of days and weeks, months even, right? This would be volatile when investments do that, right? Now, volatile does not mean that they are risky. It just means that their price can change and go up and down a lot in a short period of time, right? And this can be a good thing, this can be a bad thing, depending on what you are investing for. Now, risk is something different. Risk is when an investment has a proven track record of losing money or losing value. That would be a high risk investment, right? Or an investment that has an opportunity to lose all your money in a short period of time. That's a very high risk investment, right? But something that's volatile is not necessarily risky. And something that is risky is not necessarily volatile either. And I'll give you a couple of examples. Bitcoin is a great example of an investment that is low risk and high reward, but it's volatile. If you are needing money in the short term, let's say somewhere between 1 and 4 years, Bitcoin's not a good place to put that money. And I love Bitcoin, right? But it is volatile. You may not, the price of it may drop a lot by the time that you need it, and that would not be good for you, right? But over a long period of time, over 5, 10, 20 years, Bitcoin, even though it's volatile, even though its price is going to go up and down rapidly at times, its overall price is going to steadily climb. So over time, it is a very low risk, high reward investment. Let me give you an example of something that is actually what I would call a guaranteed risk. It's not necessarily high risk, but there is just a guaranteed risk that it is going to lose value for you over time, and that is bonds. Bonds, over time, the number value or the dollar value may go up on them, but the actual value, when you adjust it for inflation, you actually are able to buy, when you buy the average bonds 5, 10 years from now, you may have more money invested in those things. The dollar number may be bigger, but the ability that you have, the purchasing power, the buying power, the value of those bonds will buy you less goods, services, whatever you spend your money on 5, 10 years from now than they will today. That's not a good thing. That is risky to hold an investment like that. And many people will tell you that bonds are low risk. They're not. And they're not necessarily high risk either, but there's something I like to call a guaranteed risk. They are almost, if you look at the track record and the history of bonds, they are guaranteed to lose you value over time, to lose that power to buy things that you need. Over time, they just don't keep up with inflation. You're losing your value. Now, over a long period of time, this is a bad thing. Over a short period of time, there is a use for bonds and things like this. Over a short period of time, because bonds are not traditionally volatile, their price doesn't traditionally go up. Historically, it doesn't go up and down a lot in short periods of time. It's a good thing to hold money in that you may need over the next 1, 2, 3, 4 years, right? If I was going to, actually, it's how I invest. If I have money that I need for the long term, for 4 years or longer, it's invested in Bitcoin and other things. Mainly Bitcoin right now, because Bitcoin, I put equal amounts into Bitcoin and my other investments, and Bitcoin is now 90% of my portfolio because of how well it has performed over the last 10 years. It's been ridiculous, and I still put in the same amount as I do into other investments. It just grows a lot more. It is a very low risk, very high reward investment. And for long-term things, it's great. Short-term, not so great. You just don't know where the price of it's going to be. You don't know where the value of it's going to be. Bitcoin does have a history of going down in volatile periods, losing 50, 60, 75, 80% of its value. This has all happened, and it bounces back, and it's a very normal part of the Bitcoin network and everything. It is a truly free market, the freest market I'm aware of that we have currently. And because it is so free and there's not people trying to put price controls on it or manipulate it in the way other markets can be manipulated, it tends to be more volatile. And this is actually a good thing too, because it shakes out people that are scammers, fraudsters that want to do harm, that want to abuse Bitcoin, and people who buy Bitcoin. Things like Mt. Gox, FTX, you may have heard of. These fraudsters, these scammers, were not found out by regulators, right? By people who work for the government that monitor investments and whatnot. It was found out by the volatility of Bitcoin. They were exposed, or they were brought to light because they had made bad and in some cases absolutely fraudulent, dishonest moves with people's money. And the volatility of Bitcoin uncovered them, and then the regulators came in and punished them, right? So volatility is a good thing over the long term. Short term, it can really hurt, right? Back in 2008, the Great Recession, things that weren't supposed to be volatile became very volatile, and the price of a lot of things, including bonds, went down a lot. And people who were getting ready to retire around 2008 found themselves having to work several more years because the value of their portfolio, the investments that they had built up for their own financial freedom to retire on, lost 50% or more of their value. Even people who were using a lot of bonds. It was a huge setback for these people, right? So these things can happen. And I like to plan for these things. But in order to plan well for these things, you need to understand how these things work. You need to understand the difference between volatility and risk, right? That volatility is how much the price can go up and down over short periods of time, right? As well as risk, which is what is the track record of this investment, right? Does it have a long and established, provable, proven track record over time of earning people money, increasing their value and not losing it? Or does it have a record of losing people's money, whether it's on a small level consistently or a lot all at once, right? That is what risk is. And you have to understand these things, and you want to be looking for low risk, high reward investments that have proven to be safe over a long period of time and have been proven to get you results, to earn you money, and more importantly, to earn you value, right? To grow the value of your money so that you can buy more with it in the future than you can today. And you don't mind if these things are a little bit volatile, right? Over the long term. But you need to understand that over the short term, you don't want things to be volatile, all right? So again, volatility and risk are not the same thing, even though you will hear people talk about things that are volatile being risky, or things that are risky not being volatile. Sometimes it correlates, sometimes they match up, sometimes, most of the time they don't. And unless you understand the difference between the two, you might find yourself being confused and following advice that just isn't good for you. And there's a lot of people out there that are giving out investing advice that isn't good for you. It's good for them. That's how they make their money. They don't make money. Most of the people in the financial game don't make money by making sure you make money. They make money selling you things. They make commissions, right? And so they are A-OK telling you that you should be in a balanced portfolio of 60% stocks, 40% bonds, or 60% bonds and 40% stocks, because they make commissions when you buy those things, right? They don't make their money when you do well, and you want to invest with people and take advice from people that have skin in the game, right? That they're going to do well when you follow their advice and you do well, they're doing well too. And when you follow their advice and they're not doing well, they don't do well either, right? These people have skin in the game. They have a vested interest in making sure the advice they give you succeeds because they're using it themselves. All right, so remember this. Remember volatility. Price of things can go up and can go down a ton in a short period of time. And remember, risk is the track record of an investment. Does it grow your value over a long period of time, or does it have a proven track record of losing value over time? And remember, there's times for each of these things. For low volatility, guaranteed risk investments like bonds, and then there's other times where you don't want that over the long term. It's going to punish you. It's not going to reward you. It's not going to give you the value. It's not going to grow your value like you need it to grow. If you've got any questions, please let me know in the comments. I would love to be able to clarify anything that is confusing for you that I've talked about today, or maybe you have a different opinion. I'd love to hear it too. Maybe there's something I can learn from you. I'm always open to new ideas and new ways of looking at things.